Okay, so welcome back. And I'm here with a very special guest. Some of you know who he is, Mark Ritchie. Maybe you've read him in about him in Momentum Masters. Mark, thanks for being here.
Thanks for having me back. Always great at the Master Trader program.
Yeah. So one of the reasons why I like to have Mark during the power play section, we're going to talk about power plays now. They're also, some refer to them as high tight flags, is because this is one of Mark's favorite patterns, and he's done very well at playing these over the years. And we've been in a number of names at the same time, which we're gonna show you today. Some of the names that both of us have bought. And sometimes played them a little bit differently on the profit side. Mark tends to hold them and go for sometimes bigger moves than I do. But we first want to just let's give you a definition of what a power play is. It's really, and we talked about the magnitude play, and that's the IPO base, that first primary base or second base after the company goes IPO, and that's where you can get your biggest move, because that's the earliest that you can get on board a stock, unless you got on it on the IPO. Well, the velocity play is what we call the power play, a velocity play, because this is something that actually starts with velocity, and then the velocity begets velocity. So they can move very, very fast and make very big gains. It's a very powerful pattern. It's also one of the hardest ones to interpret correctly. A lot of people will always come up with stocks and ask us, if this is a power play, right, Mark? We get a lot of questions in the training room and during the week with the MPA platform, and a lot of times, they'll ask about power plays, and they're not always meet all the definitions.
Yeah, I would say this is one of the more misidentified of the Minervini patterns, if you will.
Yeah. So let's just start by giving you a definition. So the power play starts off with a very explosive price action, a very explosive move that shoots up in 100% or more. So it has to go up at least 100%. And that may sound like, wow, the stock's already up 100%. Why would we buy it there? Because it's telling you something really extraordinary is going on. The fact that it goes up so much in such a short period of time, and that time frame that we want to see it go up that 100% is in 8 weeks or less. Some of them do it in just a couple days sometimes, but that explosion in price gives you a pretty good confidence that there's definitely something going on. Now it's just a matter of whether you can get on board at a lower risk entry point, and if it's going to continue, if it's going to sustain itself, if it's a flash in the pan, or if it really is something that's long lasting. So now once this stock runs up like this, and they will generally they'll run up either on some type of news item. Sometimes it's an earnings report. Very often they're in biotech names that they have drug approval, or they have have a drug in the pipeline, and it goes through one of the phases and has a good outcome. And to be honest with you, ones that I like the most are the ones that go up on no news at all. What I call unexplained strength. So those are the ones that I think they're off most radars. And either way, though, as long as it meets this criteria, whether it has news or not, I'm going to still entertain them. Then once the stock goes up and it makes this double or more, and sometimes they're up a couple 100%. Once it does that, then we're looking for it to move sideways and go into a relatively tight trading consolidation of no more than 20% from peak to trough. And generally, these will take 3 to 6 weeks, but sometimes they come out. And certainly, when the bull market is advanced in its maturity, you'll start to see them come out earlier and earlier as retail players get in there and start anticipating these, and they come out sometimes in just 10 or 12 days. As a matter of fact, lately we've been seeing them come out in sometimes like 7 days, right?
Yeah, it seems like a little earlier, but generally, I like the 2.5 weeks or more.
Yeah, me too. So I like to see 10, 12 days minimum. So we're going to show you a bunch of examples here. Well, pretty much most of them I traded, and Mark also traded some of these. Some of them are more recent, and some of them go back a ways. And then we'll start explaining to you the nuances of these setups. So first is Best Buy, which this stock made a huge, enormous move subsequent to this. Now you can see how much it's already up. And again, these prices, I know I've said this a bunch of times, but I want to make sure you understand these prices are adjusted for split. So the stock was not trading at $2 or $3 at the time. It was trading much higher, but we're adjusted for split. So it's going to show up like that now. So you can see the stock went from $1 change all the way up to about $3. So this is several 100% move in a very short period of time. And then you can see it consolidates and then it comes right out here. You got to pause, pivot, that one little day of pause, breaks out and goes up almost 1,000% in 19 months. You also have that 1-2 punch that I talked about before, where you see you have the volume, and this was right around Christmas. So you're definitely going to get that holiday volume dry up. But you can see the volumes down, and then on the breakout day, the volume comes up. So Mark, just want you to share. You've been looking at these, for I don't know, about a decade now, and traded a boatload of them, and you've sort of come to the conclusion that these are setups that you shouldn't sell too soon, because they can make such big moves. Why don't you just tell us a little bit about how you came about your sort of general rules of thumb with these?
Sure. So, as you always advise, tracking your trades, there's just a wealth of information, in tracking everything, taking good notes, and then you can see, some of your own tendencies. And so I was marking, power plays when they were clearly identifiable, say in my spreadsheet. And then I think it was after the 2015 or so, 15 or 16 master trader program, where seeing some examples then that I had traded in the previous few years, going, holy smokes, I took a 12% gainer and the thing was up, another 30% in a few more days. And so I just I studied every one and noticed sort of really two rules. One was always make them stop you out. Was one rule I came up with, meaning don't override the original stop. Where sometimes, maybe you buy a name, it doesn't really break out, and then it pulls back into the range and you choke off the trade, which sometimes I will do from time to time. But, if a stock turns around and goes up 30% in 3 or 4 days, it's not worth it to save 2% from your stop, say, when you choke it off like that. And so there were 1 or 2 examples that had huge moves after I'd choked them off before they'd hit my stop. And I just did the math and said, well, my goodness, choking these off was, it's far more expensive to give up that potential upside. So that was the first rule. And then the other was, the original rule when I first came to the Master Trader program was to try and give them, say, 20 days or so. So I kind of looked at saying, how do you either give them 20 to 25% before taking profits? This is into strength, of course. If I get in a multiple of my average risk, I'll generally move up my stop. But so my rule became sort of 20 days or 20 to 25% gain before I'm going to take profits on one of these into strength.
So it would be fair to say that, with these, you want to give them the benefit of the doubt and try to give them as much, room as possible to make that gain. And the reasoning behind it is because they're very powerful, and these are the stocks that and the setups that can make those gains very quickly. That's why we call them velocity plays. So now I also had a rule. I noticed this is decades ago, where I was trading these high RS 98, 99 high alpha names and setting up as power plays back in the 90s. And I just came up with a rule that if a stock that was trading at the top 1 or 2% of RS, 98, 99 relative strength, and it set up in a base, in particular if it was a power play setup, I bought it no matter what. It didn't matter what the story was, the earnings, no matter what, I just bought it coming out of the base. And even to this day, I pretty much stick to that rule. So these are setups that you really don't need the earnings. If there's no earnings on the table, you can be rest assured that something's going on. A stock doesn't double in a couple of weeks or even 4 or 8 weeks, and then not correct very much if something's not going on, if there's not a ton of demand. And that demand tells you that something exciting is happening. Like I said, it's just a matter of if it's going to continue. The other thing, the reason why that we require them not to correct too much is because once you just think about it, the stock goes up that huge amount. You would think there'd be so much profit taking, right? But it doesn't succumb to profit taking. It only corrects 10, 15, 20% off the highs and doesn't correct any more than that. That's again telling you that not only is there strength on the liftoff, but there's still buying in there. There's no supply coming to market. So even the people that, the smart money that maybe ran that up, because institutions, it's definitely going up 100% in a few weeks on institutional buying. So they're not selling either. In fact, they might be adding to the position. That's what we're hoping for. Let me show you a couple more examples, then we'll slowly go through these a little at a time. So here's one that actually I traded this. And if you can see a couple things, first of all, it still has the VCP action. All right. You're still looking for that VCP action. Now, sometimes if it's tight enough, the times where you don't need VCP action, the only time that I will trade without tightening from left to right in a VCP, fashion is if it's tight, it's so tight that it's already in that single digit or very close, maybe 10 or 11%. So that would be sort of a flat base, and it's already so tight. So it would be the 1T, if you will, would be tight enough in itself. So if this was, from peak to trough, only corrected 10%, that's tight enough. That's tight enough. And I'll buy it coming out, even if it doesn't tighten up on the right side, if it just goes back and forth. Now you can see here, you had some acceleration in earnings too. You had negative earnings in 150, 177%. You had the volume, same thing, where you see how you go down and you dry up, it gets real tight. Same exact principles. Nothing changes. You come way down in volume, and look at the contrast. Look at the 1-2 punch there, where you come down to just about the lowest volume that you can see, certainly in this move here, and then a huge volume, huge volume on the upside on the breakout. This went up in 66 days, 126%. So you can imagine how much you can compound your money at that with those kind of moves, right? So Taser is another one. This is one that I took a long sabbatical from the market when I retired originally, and I started sort of getting out of the business, if you will, in 2001 or so. And by 2002, I was pretty much retired, and I didn't trade much to that whole bear market. 2003, market bottomed, and by 2004, one of the first stocks that I was buying was this stock right here, which was Taser. And this is actually one that Business Week did a story, and it was sort of my return to the market. And this went up. I made, I think, 160% on it. I think the number was, but it went up 300 and almost 30% in 16 weeks. So again, just a perfect power play. And this course, we looked at this name earlier, and this is one that was up, I think tenfold before I even was purchasing it. So, and actually, you actually could have purchased it right here. You can see there's another little base right here. I'm just showing you where I was buying it. I was actually buying it coming out right here, but it had already set up prior to that right here, nice and tight. It actually set up right here. You can see a little VCP action, and see how tight this is. This is so tight that, there's really not much VCP action because you don't need it. It's just so tight to begin with. And then right here, you have the tightening left to right, and then you got it again. And actually after this, you got a few more opportunities to get on it. Now, I'm trying to remember, Mark, do you remember pharmacyclics? Were you around during this one?
Absolutely. So this one, kind of a funny story. This was this was before the days of Twitter, but you put this one on StockTwits. I remember it very well. because I just started following you, and I was in the camp of what is it? This was not split adjusted, if memory serves me correct, because it was a low price stock.
It was.
I think you said, I don't normally trade these low price stocks, but this one looks pretty good to me. You didn't call it a power play or whatever. This was before Master Trader Program or anything like that. And this thing, I remember, just having it on my screen, and it went up every day for and sure enough, in 2 weeks, it was up like 50%. And I was like, this is insane. I couldn't believe it. So then I started following you a little closer, and I actually bought it, I think later around 6.5, or one of those pivots up around $6. This stock just had an absolutely monster move over the next few years.
I think it went up even more. I have it here pegged at 2,600% in 43 months. I think it went. I think it ended up getting acquired, and
it was bought out in the multi-hundreds. I think, a few hundred.
Huge mover, and you can see never turned back. But in 48 days, it was up 100%. The interesting thing about this one, and one of the reasons why I don't normally buy these lower price stocks, but the market was in a correction, and this actually broke out the day before the market made its low. One day before, there was one more day down in the Dow and Nasdaq, and it made its low the very next day after this stock broke out. So it was coming right off the low, as coincident as you can get. Remember, we talked about leading, coincident, and confirming. This was coincident right off the low of the market. So again, you can see it had the VCP characteristics, little cheat area, if you will, semantics, of course, but you can see the tightening from left to right. Let me show you another one. Now, of course, this is in 2014. You might remember this one, Mark, as well, AMAG. And again, you could have been buying it over here where it came out right here. It did tighten up, but I hadn't seen that yet. Okay, so I was up to this point right here, and I was already buying it right here. Then it went inside for a few days and then had a really nice breakout, and I felt pretty confident. Once that happened, I was like, okay, this thing's working out really good. Got another pivot, an even better pivot. It actually improved. Again, you see these moves and how the short term they are and how big it is in a very short period of time, 143% in 9 months. And this is why Mark was saying he wants to give them the benefit of the doubt. You don't want to release this hand or let go of this tiger's tail, too easily, because then you're sitting there. Mark, how many times like you said, you sold it, you took a 15% profit, and then 10 days later it's up 40. It's up 40 more percent, right?
Exactly. And you brought up a great point about the pharmacyclics too. Like when you see them around potential lows, and here's a stock that is doubled and not giving anything back, that thing is telling you something. It's not succumbing. You often say these stocks march to the beat of their own drummer. They're ignoring the general market. And think of how much stronger a stock has to be when you've got a market under correction and this thing is just pegged near the highs. That stock is screaming at you that something exciting is potentially going on there.
Right. So that's a good point. I meant to say that. So I'm glad you brought that up. Let's talk about marching to your own drummer. So what Mark's referring to is that when we get these stocks that are all alpha, there's so much alpha here. It's, a performance above the market. These stocks are in their own earning cycle, product cycle. They're in their own cycle. They're really not when you have a move like this and you have this kind of power and it's sporting this level of relative strength and alpha, the market's not really affecting them very much. You'll find sometimes the market will be in a correction or it'll have, big down days, and these stocks don't respond at all. They don't come off with the market. So I find that, number one, I would like to be in this kind of name all the time because it's immune from, noise and immune from market forces. But the other thing is when the market's difficult, when we're having a difficult market environment, I tend to gravitate towards these because, again, you might be whipped all over the place in a lot of names, and the market's moving up and moving down, and it's directionless, and you're getting stopped out a lot. These stocks, not only are you going to get a better risk reward profile from them, but they're marching to their own beat. I don't know, Mark, if you ever make an adjustment like that when things aren't going well? Do you ever adjust to trying to go with the names that are higher alpha and sort of to insulate your portfolio from the noise?
Certainly, or definitely favoring those type names. You know, we always talk about not trying to have favorites, but in a period of time when things are more challenging, absolutely being more selective and going with the highest RS, like you said, or even ideally if there are power plays. Sometimes we go through periods we don't see many, but you definitely favoring those type of setups.